Welcome back to the deep dive. Today we're taking a step back from the ticker tape. We're looking at something that I think we've all suspected, but maybe never quite had the words for.
Yeah, that intuitive feeling about the market.
Exactly. When you look at the stock market, and it feels less like a strict math problem and more like like a mood ring, or maybe a battlefield of competing stories.
It's a really good way to put it. We usually get so bogged down in the numbers, the price to earnings ratios, the moving averages.
Yeah.
But at its core, the market is just people acting on ideas.
Right, and that is the exact premise of the research paper we are unpacking today. It's titled Meme, Modeling the Evolutionary Modes of Financial Markets.
Mm.
And before you ask, no, this isn't about Dogecoin or stocks with funny cat pictures.
Although, honestly, that would be a fun deep dive, too.
It really would be, but this is actually an acronym.
Right, it stands for Modeling the Evolutionary Modes. The paper is by Tian Guo and a team from Peking University, released in 2026. And their mission here is pretty ambitious. They want to completely shift how AI looks at finance.
So instead of asking which stock is going to go up tomorrow, they're asking why is the market moving right now? And more importantly, which story or which logic is currently winning the argument?
Precisely. It's a shift from being asset-centric to being logic-oriented. They're treating the market not as a giant spreadsheet of prices, but as this evolutionary ecosystem. Different modes of thought are born, they gain popularity, dominate for a bit, and then eventually die out.
That sounds almost biological, like a survival of the fittest, but for investment strategies.
That is exactly the analogy they use. They view these investment ideas as living organisms competing for capital.
Okay, let's unpack this. Because to understand why this meme framework is so special, we first have to understand what everyone else is doing wrong, or I guess what the current limitations are. The paper talks about asset-centric and market-centric models. What's the beef there?
So think about how most AI in finance works right now. If you have an asset-centric model, you are laser-focused on one specific stock. You're looking at Apple or Tesla, analyzing their specific news, their charts, trying to predict that one price.
Like looking at a single tree and trying to guess how tall it'll grow, completely ignoring the rest of the forest.
Right. And then you have the market-centric models. These are more about portfolio construction. They look at the whole pool of stocks and try to decide the optimal weights. How much of this, how much of that to balance risk and return.
So that's looking at the whole forest, but maybe just treating it
As
as...
a lump of biomass. Yes.
Oh.
The authors argue that both of these approaches are basically object-oriented. They treat the market as static data points. They see the price, the volume, but they completely miss the why.
They ignore the reasoning.
Exactly. They ignore the narrative that is actually driving those numbers. And this leads to two huge problems. First, noise. Financial data is notoriously noisy. You've got news, fundamentals, technical indicators. It's a chaotic mess. If you don't know the why, it is incredibly hard to separate the signal from the static.
And the second problem?
The logic problem. This is fascinating. Even if you do find a signal, the logic behind it might be flawed. There are plenty of narratives that sound totally plausible, like buy this because X happened, but empirically they don't actually make money. That is what they call logical noise.
Oh, I feel attacked. I have definitely bought stocks based on logical noise before. It sounds good, so it must be true.
We all have. You hear a compelling story, maybe something about how millennials love avocado toast, so buy avocado futures, and it sounds perfectly logical, but the market might completely ignore that logic.
Or worse, the market agrees with the logic, but the price still goes down anyway.
Right. And that's what Mean tries to solve. It doesn't just look at the stocks. It tracks the strategies themselves, the modes of thought. It wants to know which logic is actually paying rent right now.
Okay, so let's get into the mechanics of this beast. How does meme actually work? Because it sounds like it needs to read the market's mind, which frankly is a terrifying thought given how chaotic the market is.
It essentially does read the market's mind using a three-stage process. And it starts with dealing with that noise we just talked about. Stage one is argument extraction.
This is why they use those agents, right?
Yes, a multi-agent system. Imagine a room full of highly specialized analysts. You have filter agents who are assigned to specific areas. One looks only at fundamentals like financial reports and PE ratios. Another looks only at the news. Another looks only at technicals.
So they aren't getting distracted by each other's data? The technical guy isn't scrolling through news headlines?
Exactly, they stay in their lanes. They filter the raw data down to just the relevant info. Then, they pass that up to a generator agent. That agent's job is to synthesize all of it into a structured investment argument.
And the paper is very specific about what counts as an argument, isn't it? It can't just be a vague feeling.
No, not at all. To be a valid argument in this system, it must have three distinct parts. First, polarity. Is this bullish or bearish? Second, rationale. What is the logic? And third, evidence. What is the proof?
So it's turning the chaotic noise of the internet and stock tickers into a very structured list of debates. I think stock X is going up because of Y, and here's Z evidence.
Correct. But here's where it gets really tricky. If you just stop there, you'd have thousands of individual arguments generated every single day. Buy Apple because it's cheap, buy Tesla because it's growing. It would still be a massive mess.
Right, you just have a very organized pile of noise.
Exactly. So stage 2 is mode identification. This is the clustering part. The system takes all those thousands of arguments and looks for patterns in a semantic space. It groups them together.
But the paper mentions a specific type of math here, Gaussian Mixture Modeling, or GMM. Why did they use that instead of just, putting things in rigid boxes?
Think of it this way. Traditional clustering puts things in strict categories. This is a value argument, or this is a momentum argument. But in the real world, ideas overlap.
Like a movie genre. A movie can be an action movie and a comedy at the exact same time.
Perfect analogy. An argument about a company's strong cash flow might be partly a value argument, but also partly a defensive argument, because the broader market is crashing. GMM allows for those shades of gray.
Okay, so it captures the nuance.
Right. It recognizes latent consensus. It sees that a single argument might belong to multiple overlapping themes or modes at the same time. So instead of just seeing individual stock tips, the system starts to see these big glowing clouds of logic. Oh, 40% of the market is currently arguing about supply chain safety.
I really like that visual. So we've extracted the arguments, we've grouped them into these modes of thought. What happens next?
Stage 3 is temporal alignment. Or, in plain English, tracking the life cycle.
Because a good idea today might be a terrible idea tomorrow.
Precisely. Narratives suffer from semantic drift. The definition of value investing might look slightly different in a high interest rate environment versus a low one. Meme links these modes across consecutive days. It watches them evolve.
So it's not just taking a snapshot, it's watching the movie. It's seeing the character arc of the investment logic.
That is a brilliant way to describe it. It sees a specific logic emerge, gain consensus. Maybe everyone suddenly starts talking about AI hardware, and then it watches it eventually decay as the market just moves on to the next shiny thing.
This is the part that I find most compelling, really, the so what factor. Because just because everyone is talking about a narrative doesn't mean you should bet on it. We've all seen popular narratives burn people. The dot-com bubble was a very popular narrative.
And that is the crux of the paper. Meme isn't a popularity contest. It's a profitability contest. This is where the rubber meets the road. It doesn't just track if an idea is trending. It tracks if it makes money.
How does it score them?
It looks at the realized returns of the stocks associated with a specific mode. If the high dividend mode says to buy these 10 stocks and those 10 stocks actually go up, that mode gets a high score.
Simple enough. It checks the receipts.
But there is a catch. Markets are noisy. Sometimes the strategy works for one day, purely by luck. So, Meme uses an exponential moving average, an EMA, to track the long-term performance of a mode. It filters out the sleeting, high-frequency anomalies.
It wants to find the old man wisdom of the market, not the one-hit wonder.
Exactly. It prioritizes enduring market wisdom. When it constructs the final portfolio, it weights the new signals based on how successful that specific mode of thought has been in the recent past.
So if buying tech breakouts has been losing money for the last month, Meme effectively says, I hear your argument, but I'm going to ignore you for now because your logic is currently broken.
And conversely, if boring utility stocks have been winning for 3 weeks, it says, I'm listening to this logic. This logic is currently profitable.
All right, that sounds great in theory. It sounds like the perfect investment committee inside a computer. But did it actually work? Or is this just another academic paper that looks amazing until you try to trade it with real money?
Oh, they tested it thoroughly. They used 3 major Chinese stock pools. The SSE 50, which is large cap blue chips, the CSI 300, which is the broad market, and the CSI 500 for mid to small caps.
And the time frame.
Late 2023 to late 2025.
Oh, wow. That is a spicy time frame. You had that nasty bear market at the end of 23, a liquidity crisis in there somewhere, and then a massive bull run starting in September 24. That is a real stress test.
It really is. That's why it's such a good data set. A model that only works in a bull market would have failed half the time. If you train a model just to buy the dip, it would have been absolutely crushed in early 2024. If you trained it to short everything, it would have been destroyed in late 2024.
So the model had to pivot.
It had to adapt its logic dynamically. Yeah. They compared meme against 7 different baselines. They put it up against traditional machine learning like LightGBM, deep learning models like FactorVE and Master, and even other agent-based models like SEP and trading agents.
And the results.
It wasn't even close. Meme consistently outperformed all 7 competitors. It had the highest annualized return, but maybe more importantly for everyday investors, it had the best stability. The Sharpe ratio, which measures risk-adjusted return, was higher, and the maximum drawdown, the worst crash it experienced, was significantly lower.
So it made more money and gave the investors fewer heart attacks. That's the dream combo right there.
And to prove it wasn't just memorizing the past, they did an out-of-sample test in Q4 2025. It performed incredibly well, even on data the model had never seen during its training phase.
That robustness is key. But I want to go back to this idea of modes. I think that's the coolest part of this framework. Did they give us any concrete examples of what these modes actually looked like during the test? Because mode of thought is a little abstract.
They did. They actually categorized the modes based on when they worked. They found modes that were bear market effective, bull market effective, and long-term effective.
Let's start with the bear market. When everything is crashing and burning, what was the winning thought?
The defensive logic. The paper highlights early 2024. The market was incredibly rough. The winning mode focused heavily on high dividends and strong cash flow.
Makes sense. Flight to safety.
Right. They give the example of China Mobile in January 2024. The argument extracted by the system was explicitly about the attractive dividend yield, which was 4.15% at the time, providing downside protection.
So the system saw market is scary and pivoted to cash is king. It loaded up on the boring, safe stuff.
Yes. But here is the critical part, the tracking of the life cycle. That logic dominated the downturn. But when the bull market started in September 2024, that specific mode lost relevance. It didn't stop being true. China Mobile still had dividends, but the market didn't care anymore.
The narrative shifted.
Exactly. So meme deprioritized it. It stopped listening to the safety guy and started listening to the party guy. Which brings us to the bull market effective modes.
Okay, so now the market is ripping. What logic works now?
In the bull market phases, like May 2024 or July 2025, aggressive logic took over. Technical breakouts, momentum, capital inflows.
A line goes up logic. Pure FOMO.
The examples they give are stocks like Quai or SMIC. The arguments weren't about safety at all. They were about price-crossing moving averages, high RSI, or a surge in margin financing.
The logic basically became, people are buying, so we should buy.
Correct. And that logic fails miserably in a bear market. If you try to play momentum when the market is tanking, you get crushed. Meme recognized that this mode of thought was toxic in 2023, but highly profitable in late 2024.
It's incredible because usually you pay a human fund manager 2 and 20 to make that call, to wake up one morning and say, hey, I think sentiment is shifting. But here, the machine is measuring the profitability of the conversation itself.
That is the big takeaway. The best strategy isn't static. It's not always by value or always by growth. Meme succeeds because it dynamically shifts its weight. It sees that the defensive dividend logic is fading and the aggressive technical logic is rising, and it adjusts the portfolio accordingly.
And then there's the long-term effective, the evergreen logic. What fits in there?
This is your classic fundamental logic. Undervaluation and mean reversion. The example was Ping and Bank. The argument was that the PE ratio was historically low, in the bottom 2.8th percentile.
It's too cheap to ignore.
Exactly. That kind of logic tends to work steadily over time, regardless of the immediate chaos. Meme keeps a baseline of these stocks while rotating the speculative part of the portfolio based on the current mode.
It really does sound like a complete investment committee inside a microchip. You have the risky guy, the safety guy, and the long-term guy, and the algorithm is just the chairman deciding who gets the money this month.
That's a perfect analogy. Yeah. And it does it completely without ego. A human manager might be a hardcore value guy who refuses to buy expensive tech stocks on principle. Meme doesn't care. If value isn't working, meme dumps it.
It has no religion, just returns.
Precisely.
So we have this system that filters noise, identifies the consensus, and tracks the life cycle of ideas to separate actual wisdom from fads.
It's a huge step forward from just crunching price data.
It represents a fundamental shift in quantitative finance. We're moving from analyzing the assets, the things, to analyzing the evolution of the investment logic, the thoughts about the things.
It makes you wonder, if they can do this for finance, what else can they do it for?
That is the bigger picture question. Finance is really just one complex human system where people trade on narratives.
Right. Politics is the obvious one that comes to mind.
Politics, absolutely. You could model polling data not just as raw numbers, but as competing modes of thought or policy narratives. Which argument is actually winning the electorate? Economic safety or social progress? You could track which slogans are gaining market share in the voter's mind and which ones are suffering from semantic drift.
Or social trends. Fashion is a great example. Why does a specific style of jeans suddenly take over the world and then vanish 3 years later?
Or why wide-leg pants are cool now and skinny jeans are completely dead.
Exactly. If AI can now track the life cycle of a thought in a financial market, it implies we can model almost any system where human belief drives the outcome. We could stop looking at raw data points like votes, sales, clicks, and start modeling the evolutionary battle of the ideas behind those actions.
That is both incredibly cool and slightly terrifying. Imagine an AI that knows your mode of thought is about to go out of style before you even do.
It creates the real possibility of computational sociology. Instead of just polling people or tracking purchases, you model the life cycle of their underlying beliefs.
On that slightly ominous note, we are going to wrap up this deep dive into meme. It is a fascinating paper, and it really changes how you look at that stock ticker. It's not just numbers flashing red and green. It's a living history of winning and losing ideas.
A constant battle of logic.
Exactly. The market isn't a calculator, it's a debate club. And the winner of the debate changes every few months. If you are still using the logic that won the last debate, you're probably losing money.
And for the very first time, we actually have the tools to track who is winning that debate in real time.
Thanks for tuning in. I highly recommend you check out the full paper by Guo and his team. It is heavy on the math, lots of GMMs and EMAs, but the charts showing the logic shifts are worth a look, even if you skip the equations entirely. We will see you on the next one.